Welcome to class students. In today's module, we'll be looking at a very important topic titled Mortality Risks in Life Insurance. Mortality Risks in Life Insurance. Module content: Introduction, Sources of mortality risks, mortality risk measurement, underwriting and risk classification, risk classes, mortality improvement and deterioration, longevity risks in annuities, and mortality improvement skills. Introduction. Mortality risk is the uncertainty in which death will occur. The uncertainty in which death will occur. For life insurance, the primary risk is the actual death exceed expected death. For life insurance, the primary risk is that actual death exceed expected death. Sources of mortality risk: we have level risk, we have trend risk, we have the mortality risk, we have the catastrophe risk and the selection risk. The level risk: death occurring as expected but mortality level higher than assumed in pricing. While in trend risks, unexpected changes in mortality improvement rate or deterioration. Volatility risks: random fluctuation in death claims year to year. While catastrophic risks: extreme events like pandemic, terrorism, natural disasters causing multiple deaths. While selection risks: adverse selection where poorer risks disproportionately purchase or retain coverage. Mortality risk measurement: we have the actual to expected, that is AE ratio. We have the mortality margin and statistical fluctuation. The actual to expected AE ratios comparing actual deaths to expected based on pricing assumption. Like we have AE that is less than 100% indicate favorable experience, while AE greater than 100% indicate adverse experience. But mortality margin: the difference between pricing mortality and valuation mortality. Conservative valuation mortality provides cushion against adverse experience. Regulatory requirements often mandate margins. Statistical fluctuation: for a portfolio of N policies with death probability Q, so expected death is N times Q, while standard deviation of it is there. Then larger portfolio have relative volatility per unit of exposure. Underwriting and risk classification. Purpose: classify applicants into risk groups with similar mortality expectations to ensure equitable pricing. Underwriting sources: we have medical examination and laboratory tests, attending physician's statement, medical information bureaus, that is IMB, prescription drug databases, motor vehicle reports, credit reports in some jurisdictions, and social media and public records emerging. Classes: we have the preferred plus elite, we have preferred, we have standard, we have the rated table, rated like table rated, we have the declined. We also have the preferred plus elite, best mortality, lowest premium. So we have preferred, better than standard mortality. We have standard, expected mortality for healthy individual. We have rated / table rated, substandard mortality with premium, surcharge table B 150 of standard, table D 200 etc. Declined are uninsurable applicants. Isolated underwriting: using predictive models and big data to reduce or eliminate traditional underwriting for lower face amounts. Benefits: faster issue, better customer experience and lower cost. We have challenges. Challenges of these risk classes are model validation, we have regulatory approval and anti-selection risks. Mortality improvement and deterioration. We have historical trends. Mortality has generally improved over time due to medical advances, better nutrition and lifestyle, occupational safety improvement and reduced smoking prevalence. So there have been improvements in mortality due to medical advances, due to better nutrition and lifestyle exposure, and occupational safety improvements, and also reduce smoking prevalence. Projection method, we have the linear improvement, the Lee-Carter model, the Klein's Black Dawn, that is CBD model, and continuous mortality investigation CMI models. The linear improvement, constant percentage improvements per year. We have the Lee-Carter model, which stochastic model decomposing mortality into age-specific and time-specific components. We have the Cairns Black-Dowd model, two-factor model for older ages. We have the continuous mortality investigation CMI models, that is UK models with parameters for long-term rate and smoothing. Recent concerns. Some population, particularly middle-aged, less educated Americans, have experienced mortality deterioration due to death of despair, that is suicide due to drugs and due to alcohol. Also have the COVID-19 impact. The pandemic caused significant mortality spikes from 2020 to 2021, saw substantial access deaths. Then long-term effects on mortality trends remain uncertain. Implications for pricing and reserving are still evolving. We have the risks, longevity risk in annuities. Longevity risk is the risk that annuitants live longer than expected, increasing the insurer's obligation to continue payment. Nature of longevity risk. We have systematic longevity risk, mortality improvement affecting the entire population. We have medical breakthroughs extending lifespan. We have lifestyle changes promoting longevity. We have cannot be diversified within annuity portfolio. Then major risks of annuity writers and pension plans. So these are the features of the systematic longevity risk. Is a medical breakthrough extending lifespan, lifestyle and lifestyle changes promoting longevity. It cannot be diversified within annuity portfolios, and major risks of annuity writers and pension plans. We have longevity risks in annuities. We are in longevity risks in annuity. We have idiosyncratic idiosyncratic longevity risks, uncertainty in future employment. Let's start from idiosyncratic longevity risk. Is individual variation in mortality can be diversified through large portfolios and less significant for well diversified insurance. Uncertainty in future improvement. We have difficulty predicting mortality trends, that is the historical patterns may not continue. They will have potential for accelerating or decelerating improvement, and uncertainty increases with projection horizon. While the improvement skills purpose project future mortality improvement for cohorts retiring in future years. Scale MP 2021, Society of Actuaries United States. There are age-specific improvement rates, specific rates by gender, incorporate short-term and long-term improvement trends, and based on Social Security Administration data and other sources. We also have the CMI models. That is, CMI means continuous mortality investigation, which is done in United Kingdom. Parameter driven models allowing customization, long-term improvement rate assumption. long-term improvement rate assumption, initial adjustment period, then smoothing parameter, calibration, fitting improvement scales to historical population experience and expert judgment about future trends. Thank you for listening.